Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about International SEAWAYS INC quarterly report. International Seaways Inc. provides a range of businesses and services including transportation of crude oil and petroleum products ship-to-ship, SDS, lightering support services full-service SDS lightering, that includes lightering vessels Mr. Product carriers for carrying edible oils such as palm and vegetable oil services to independent and state-owned oil companies, oil traders, refinery operators, and international government entities. International Seaways, Inc.'s stock price has seen a significant increase of 40.8% year-to-date and 16.15% over the last 12 months. Several key factors have contributed to this growth. Strong financial performance was a major driver, with the company exceeding earnings estimates in both Q2 and Q1 2025. International Seaways also reported robust adjusted EBITDA of $102 million in Q2 2025. The company's fleet optimization program, which included selling older vessels and acquiring a newer VLCC, has improved its financial position. Additionally, maintaining strong liquidity with $709 million, including $149 million in cash, has provided stability. A successful bond placement of $250 million in September 2025 further boosted investor confidence. Analysts' positive outlook, with a consensus rating of moderate buy and an average price target of $52.67, also contributed to the stock's growth. The tanker industry's positive trends, such as skyrocketing day rates, are expected to have a favorable impact on companies like International Seaways. Overall, these factors have combined to drive the company's stock price upward in the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the sale of vessels, with $211.2 million in proceeds from the sale of 6 vessels. Additionally, time charter equivalent revenues increased by $27,219, 12%, in Q3 2025 compared to Q3 2024. On the other hand, revenue decline is mainly attributed to a decrease in TCE revenues by $5,824 and a slightly lower average daily TCE rate. Furthermore, voyage charter revenues from non-variable lease payments decreased by 53%, and lightering services revenue declined by 35%. The El-Roan sector rates-based decrease of $15.5 million also contributed to the decline. Overall, the sale of vessels and time charter equivalent revenues growth were key drivers of revenue growth, while decreases in TCE revenues, voyage charter revenues, and lightering services revenue led to a decline in revenue. Net income and profit margins. A decline in performance. The financial performance of a company has experienced a significant decline in net income and profit margins over the past year. For the 9 months ending September 30, 2025, net income decreased by $199,144, 52.3%, compared to the same period in 2024. Profit margins have also taken a hit, with EBITDA margin decreasing from 14.4% in Q3 2024 to 13.5% in Q3 2025, and adjusted EBITDA margin dropping from 13% to 12%. This decline in profit margins suggests that the company is struggling to maintain its pricing power or control costs effectively. The decrease in net income and profit margins indicates a challenging business environment for the company, which may be due to various factors such as increased competition, rising costs, or decreased demand. To regain momentum, the company must identify the root causes of this decline and implement strategies to improve profitability. The company's ability to generate positive operating cash flow is a mixed bag. While there are instances where the company generates significant amounts of cash from operations, such as $234,051 in 2025 and $412,569 in another instance, there are also periods where it experiences negative operating cash flow, including a net cash outflow of $2.9 million. This inconsistency suggests that the company's financial performance is not entirely stable. The company's debt level and interest expenses have undergone significant changes between December 31, 2024 and September 30, 2025. Notably, the current portion of long-term debt has increased from $50,054 in 2024 to $282,489 in 2025. Conversely, the long-term debt has decreased from $638,353 in 2024 to $509,527 in 2025. In terms of interest expenses, a notable decrease is observed. The company's interest expense for the 3 months ended September 30, 2025, was $9,623, representing a 23% decrease compared to 2024. For the 9 months ended September 30, 2025, the interest expense decreased by 18% from 2024. Overall, while the company's debt level has increased in terms of current portion, its long-term debt has decreased significantly. The interest expenses have also seen a notable decrease, indicating potential cost savings for the company. For management's outlook on company strategy, the company has outlined several key strategies and outlooks that will shape its future. Firstly, management plans to capitalize interest costs during vessel construction, indicating a focus on optimizing financial performance. The use of time charter equivalent revenues as a metric for evaluating financial performance suggests a commitment to transparency and accountability. In terms of growth, the company is investing in renewing and growing its fleet, with used incremental liquidity generated from operations being invested in this effort. This indicates a long-term strategy focused on expanding capacity and competitiveness. Management also expects to recognize significant gains from vessel sales in Q4 2025, which will be used to purchase new vessels, including a $119 million VLCC. This suggests a positive outlook on the company's ability to generate revenue and invest in its future. However, management has also acknowledged potential risks and challenges, including climate change regulations and changes in laws or regulations that may impact the business. Overall, the company appears to be focused on growth, financial optimization, and adaptability in response to changing market conditions. The company has made several significant acquisitions and divestitures. In terms of acquisitions, the company purchased 4 very large crude carriers, VLCCs, for a total of $471.2 million, including one 2010-built VLCC, 2 2011-built VLCCs, and 1 2020-built VLCC with scrubbers. Additionally, 3 medium-range tankers, Mr. S, were acquired in 2015 for $119.5 million. On the other hand, the company has divested a total of 9 vessels, including 2 VLCC sold for $233.2 million, 2 LR1 sold, and 6 Mr. S sold, consisting of 3 each from 2006, 2007, and 2008. Furthermore, 3 more Mr. Product carriers are scheduled to be sold in the 4th quarter of 2025. The company's financial summary reveals 2 key aspects of its shareholder return strategy. Firstly, it is evident that the company has a history of paying dividends to its shareholders, as mentioned on multiple pages, 4, 21, and 50. This indicates a commitment to distributing profits to investors. Secondly, the company has also engaged in share buybacks, as noted on pages 19, 20, and 50. This suggests that management is confident in the company's future prospects and is willing to invest in its own shares to boost shareholder value. That concludes the financial summary for International SEAWAYS INC. Feel free to comment below, and I will be happy to answer them when possible.